you shouldn't buy it unless you're going to hold it for the long term. Like a short period of time to hold it is 4 years. A middle period of time is 10 years. The right time horizon is the rest of your life. If you have money that you need to give to your children in 4 weeks, don't buy Bitcoin with it. If you have money you want to give to your children in 40 years, definitely buy Bitcoin with it. In 40 years, Bitcoin is going to be worth a lot more. Over the next 21 years, I think it will grow faster than the S&P, and it's going to grow to the point where it's about 7% of the world's assets. Right now, it's about 0.1% of the world's assets. And I think that it will gradually approach, but it will never be as big as the S&P index or equities. It won't ever be as big as real estate. But in that world where it decelerates from 50% down to 20%-ish, it will appreciate from 65 or 70,000 up to 13 million a coin in my base case.
Saylor begins by comparing Bitcoin to conventional investments. Bitcoin exhibits a high annualized return rate, ARR, of around 50%, with significant volatility, approximately 50. In contrast, the S&P 500 index offers lower volatility and return, both averaging around 12 to 14%. For investors seeking stable yet lower returns, traditional equity indices provide a safer option. However, Bitcoin's volatility is part of what makes it powerful. Saylor advises that Bitcoin should not be viewed as a short-term asset. Rather, it is designed for those with a multi-year or lifetime investment horizon. Saylor emphasizes that investors who hold Bitcoin for at least a decade will likely benefit from its appreciation. He warns against using Bitcoin for short-term needs, noting the unpredictability of its price over brief periods. However, as a long-term store of value, Bitcoin's scarcity and global liquidity make it superior to many traditional investments.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Bitcoin's like 50 vol, 50 ARR, and the S&P's more like 12 to 14 ARR, 14 vol. So if you want 12 vol, 12 ARR, you would just buy a diversified equity index. You'll get 1/4 the return, you'll get 1/4 the volatility, and some people like that. If you're going to buy a 50 vol asset, first of all, you shouldn't buy it unless you're going to hold it for the long term. Like a short period of time to hold it is 4 years. A middle period of time is 10 years. The right time horizon is the rest of your life. If you have money that you need to give to your children in 4 weeks, don't buy Bitcoin with it. If you have money you want to give to your children in 40 years, definitely buy Bitcoin with it. In 40 years, Bitcoin is going to be worth a lot more. In 4 weeks, there's no telling what it'll be worth. So think in terms of 0 to 4 years is very safe conventional assets. Think in terms of 4 to 10 years is more like investment things, and think beyond 10 years is that's something I'm buying to give to my great granddaughter, that it's going to be in the family for ever. It's like the center of London. It's been passed by the royal family of London down from family to family for 1,000 years. That, if you think of it like that, then you'll go into it with your eyes wide open. The volatility is a feature, it's not a bug. The reason it's volatile is because on Saturday night, if you panic and you needed to raise $1 million by selling $1 million of something you own, it's literally the only thing you can sell. You can't sell anything else. You can't sell your real estate. You can't sell your Apple stock. You can't sell your car.
That's so true.
There's nothing else you can sell. So if you can't sell it, then by definition, it's not going to be volatile because it's useless. So things that are non-volatile are useless. The volatility is what attracts the Bloomberg jockey to put up $20 billion of capital in Singapore. And that person will loan you $1 billion for 5 minutes on Saturday night at 100x leverage if your life depended on it. And you can imagine that, is that a feature or is that a bug? It's just a lot of economic power. And the fact that there's that much economic power in the network means that it attracts all of the traders, and it attracts anybody that wants to either buy or sell with leverage at any time, anywhere in the world. Once you embrace that idea, you realize that if you wanted to buy it knowing what it would be worth next Tuesday, you're a fool. But if you wanted to buy it thinking this is the most powerful digital capital network in the world for the next 100 years, and I've got a long time horizon and I just want to get rich and I'm going to hold on to it, then it's a pretty wise thing to put in your portfolio. My assumptions are the US dollar supply is going to continue to expand about 7% a year. And that is the historic rate of expansion of dollars for the past 100 years. That's how I arrive at that. That's just how fast the money supply is expanding if you look at M2. And I think that there'll be innovation from AI. So some things like equities will probably grow a little bit faster because AI is going to have a boost to equities. I think over time, gradually, technology is going to demonetize gold and some of the other stores of value assets that were used in the 20th and the 19th century. But the 21st century, we're going to digitally transform property and transform gold into digital property, digital gold. Okay. And when you look at Bitcoin's growth over the past 15 years, it's been growing more than 100% a year for the first decade or so. And for the last 4 years, it's been appreciating about 50% a year in ARR. I think it's 50% a year in ARR, and it's 50 vol, which is like 3 times the volatility of the S&P and 3 times the performance of the S&P index. Okay. Over the next 21 years, I think it will grow faster than the S&P, and it's going to grow to the point where it's about 7% of the world's assets. Right now, it's about 0.1% of the world's assets. And I think that it will gradually approach, but it will never be as big as the S&P index or equities. It won't ever be as big as real estate. But in that world where it decelerates from 50% down to 20%-ish, it will appreciate from 65 or 70,000 up to 13 million a coin in my base case. And that amounts to about a 29% ARR on average over the 21 years. And when it's half the size of the S&P, it'll still be twice as volatile, probably performing 50% better, because it's a 24/7, 365 asset. It's subject to global chaos and global capital flows, and it doesn't have all the risk factors of property or the risk factors of equity to hold it back.
One of the key takeaways from Saylor's discussion is the way Bitcoin changes how people understand money, savings, and investment. He argues that buying stocks or other corporate securities isn't true saving, but rather investing, which carries inherent risk. Bitcoin, on the other hand, offers an opportunity to save in a non-debasable asset with intrinsic scarcity. Saylor also touches on how Bitcoin enables a deeper understanding of the differences between commodities, securities, and sound money. For example, commodities typically make poor long-term investments due to inflation and fluctuating supply. However, Bitcoin, with its fixed supply and decentralized network, is an exception. Holding Bitcoin teaches investors to think differently about financial markets, inflation, and the risks of fiat currency systems.
There's a dream throughout the history of the human race of sound money, of money with integrity, something you could trust, something that you could store your life savings in and not have debased or destroyed or stolen from you. And that sound money took the form of gold after about 5,000 years. And throughout human history, the better civilizations have stood on the gold standard. And economists have always tried to create the perfect money. Gold was the closest thing to perfect money, but it was always imperfect because you could mine more gold, and it's centralized. It was easy to steal gold, and it was very slow to move. It would take a year to move gold. So there was this dream in the economic community of perfect money. And it was impossible to create perfect money or clean, sound money until the invention of the internet, combined with the invention of public-private key cryptography, combined with the invention of semiconductors. And so Bitcoin represents the engineering of perfectly sound money. And it was only possible once those three technologies advanced. And there was a group of cypherpunks that were playing with cryptography, playing with the internet. And they saw the development of hashing algorithms like SHA-256 and the ability to build that into an application-specific semiconductor. And they probably tried this 40 times. There were products like Hashcash and digital gold and BitGold and things like that. And the first 30 or 40 of them failed. And then after about 40, Bitcoin came along, and Bitcoin learned from the failures of the 40 before it. And it was the first truly decentralized crypto monetary network. And it was lucky because it just had the right monetary policy, which is absolute scarcity, 21 million. And it had the right frequency, a block every 10 minutes, the right bandwidth, the right protocols. And, when it was launched in January 3rd of 2009, did we know it was perfect? No, nobody knew it was perfect. In fact, it didn't trade for a year and a half almost. And the first time it was used for transactions was Pizza Day around May of 2010, where somebody bought 2 pizzas with 10,000 Bitcoin. So at that point, 10,000 Bitcoin, $700 million worth of Bitcoin was traded for 2 pizzas.
Yeah.
And then people thought, well, maybe it's something, but it's still kind of a hobby. And it took another decade before it wasn't a hobby.
Well, and
hence
you also had
a crypto network comes to life. Yeah, the great thing about studying Bitcoin is you won't really understand money until you've seen perfect money. So Bitcoin takes you down this path of the theory of money, and then you start to understand what's bad money and why it's bad, and what's good money and why it's good. And then that'll take you into the theory of investment. Like when you actually buy a bunch of corporate stocks to save your money, you're not saving, you're investing, you're making a bet on the stock. And so you start to understand the difference between saving your money and investing your money. And then once you understand the theory of investing, you start to understand the theory of assets. What's the difference between a commodity and a security? And why is a commodity normally a crappy investment unless it's Bitcoin, in which case it's a good investment? And then you start to understand commodities versus scarcity. So all of the investment theory, economic theory, and monetary theory that comes about when you understand Bitcoin will cause you to realize Bitcoin is just a better idea. And it will also help you make your investment decisions and make your savings decisions and navigate geopolitical currency markets and understand why does one government crash and burn, and why does hyperinflation take place one place and not another place, and how can you insulate yourself and your family from that?
Saylor believes Bitcoin will benefit from several macroeconomic trends. One of these is the continuous expansion of the U.S. dollar supply, which he estimates will grow at around 7% annually. This inflationary pressure will increase the appeal of scarce assets like Bitcoin. Additionally, Saylor anticipates that AI and technological innovation will boost equity markets, but Bitcoin will remain the most secure and liquid asset for long-term wealth preservation. Bitcoin's ability to operate independently of geopolitical risks makes it uniquely positioned for the 21st century. While real estate and equities face various regulatory and market risks, Bitcoin's decentralized nature allows it to thrive in uncertain environments, making it a resilient hedge against future economic challenges.
Please like and subscribe my channel.